I think everybody saw that presidential debate last Thursday, and if we're being honest with ourselves, it wasn't a good look for the Biden campaign. In this video, I'm going to be sticking to the facts. It's very apparent right now that the stock market is bracing for a second Trump presidency. I'll show you the data and the facts that are backing that, but then most importantly, I'll be discussing how to best position our portfolios if this does indeed play out. Now, I want to make a couple things clear. We're sitting here on July 3rd. I'm making this video. A lot can change between now and the November election. But as of now, it looks pretty apparent we are going to see another Trump presidency. Also, for all of history, half of the population has believed that, oh, if my candidate doesn't win, the economy and the stock market's going to be doomed forever. I would just encourage you all to look at the all-time chart of the S&P 500. All it's ever done, it's gone up, and it's rewarded investors that have stayed in the game. Now, I'm not saying there aren't going to be years where the stock market's down, but the overall trend has always been up, and there's no reason to worry when we have 200 years of history proving to us that there's nothing to worry about. And I know a lot of people argue right now that this time is different. This is the most important election of our lifetimes. But I'm 23 years old and I realize already that every single election, those same points come up. This is the most important election ever. It's the most important of our lifetimes. And if something doesn't go my way, things are going to break and things are going to go to hell. But in reality, that's not reality, right? Anyways, let's go ahead and jump into this. If you're new here or returning and not yet subscribed, please subscribe down below. We're getting close to 35,000 subscribers, which is crazy. I am incredibly grateful, incredibly blessed that I get to do this every day for a living and talk to you guys about the stock market. But anyways, let's get into this. So the first thing we can point to that shows the markets are bracing for this second Trump presidency is actually the long-term government bond prices, which have fallen sharply since the presidential debate. So if bond prices fall, it means that long-term treasury yields have risen. To put that in plain vanilla, it basically means that investors believe interest rates are going to stay higher for longer, which might not make a lot of sense if you follow the Trump camp because he is always pressuring the Federal Reserve to lower interest rates, to loosen financial conditions and boost the economy, stimulate the economy in any way possible, because Trump's plan is to cut taxes but outgrow any increase in the deficit. Basically, through increased GDP growth, he expects that he can outweigh any less tax revenue that comes in as a result of decreasing tax rates. In particular, we can look at the 10-year Treasury yield, which has risen to essentially 4.5% since the presidential debate, and that's the highest level since May 31st. Usually this would be insignificant, but the reason that we have to pay a lot of attention to this is because of the fact that we had our lowest year-over-year inflation print last Friday, the day after the debate, and still long-term Treasury yields went up, meaning investors believe interest rates are going to be higher for longer. If inflation numbers are better than expected and are coming down, you would expect long-term Treasury yields to actually fall, but that's not the case at all. And then just on Monday of this past week, we got a manufacturing PMI report. Basically shows you how healthy the manufacturing sector is in our country at any given point in time. It came in sub 50, which means that the manufacturing sector is still in recession. That shouldn't be a shock to many people. We've been in a goods recession here in America for many months, if not over a year. I think it is over a year and a half, maybe close to 2 years now. But again, if manufacturing and that sector of our economy is struggling to grow, you would expect that interest rates or long-term yields would actually fall because it means that we're more likely to cut interest rates to stimulate that economic growth and see that manufacturing sector actually start to recover. But again, the opposite happened. Long-term Treasury yields rose after the presidential debate. And the only way this really makes sense after record low inflation numbers and still very low and hurting manufacturing numbers is if the bond market is reacting to the increased probability of a second term in the White House for President Donald Trump. I'll explain to you why that is. If we get a little bit more granular and look at the short-term Treasury yields, so we'll look at the 2-year Treasury, it has barely moved over the past 5 trading days or since that presidential debate, while again, those long-term yields have risen quite significantly. This is what you call a bear steepening, and this is likely because investors' expectations for the economy long-term have actually increased. Investors believe the economy is going to be healthier and growing quicker than before, which means if that does happen, the Federal Reserve will have to cut rates less. Usually the Federal Reserve will cut interest rates when we enter a recession or growth in the economy is starting to slow. If that doesn't happen, they don't have a reason to cut interest rates. Another thing we can look at that is pointing to a second Trump presidency is the way real rates have reacted. It's kind of in the same tune as what I've already discussed, but we can look at the 10-year TIPS yield, TIPS yield. It stands for Treasury Inflation Protected Securities. This yield is up since the debate right alongside the 10-year Treasury yield. It's slightly different, but what this yield tells us that the 10-year Treasury yield doesn't tell us itself is that inflation expectations have actually gone up as well. So it's not all sunshine and rainbows for a second Trump presidency. Investors do believe that we will see a second bout of inflation, or it will be more sticky, or we will just, as a result of his policy, see increased inflation numbers relative to what we would see under a second Biden presidency. The way a TIPS yield works is self-explanatory. It is inflation protected, so it is benchmarked to inflation numbers. So if inflation expectations go up, the TIPS yield will also go up, and that's the red line on the chart here. You can see that has climbed slowly. So there's basically 3 things that I've covered so far that investors are expecting. They're expecting stronger economic growth, higher inflation, and also more Treasury supply if Trump does win. And I'll discuss it a little bit deeper in just a second, but to give you kind of the backbone of this, if there's more Treasury supply than Treasury demand, it means that interest rates or yields on these Treasury bills have to increase in order to get more demand for them. And obviously, if Treasury yields rise, it means more and more investors will be enticed to invest into treasuries because they get a higher and higher risk-free yield on their investment if interest rates and yields do increase. That's what takes care of that excess supply. You have to increase demand by raising rates or yields on those treasury bills and notes and bonds. But anyways, diving into this a little bit deeper, we can look at the Congressional Budget Office, or the CBO, and how they're projecting the federal budget deficit to grow to basically its pandemic record over the next coming decade. If you've been in the political arena, you would know that a big talking point has been Trump's tax cuts, which are set to expire at the end of next year, so at the end of 2025. Essentially, if Trump is reelected, he's going to extend these tax cuts, and if Biden is reelected, he's said that he'll get rid of these tax cuts. But honestly, if you ask me, I don't think he would do much, because it would be such a radical change to the economy and to businesses that it might force a recession if he took, for example, the corporate tax rate up from 21% currently to 35%. That's a 14% increase in tax rates, which hurts corporates' net profits and net incomes, which means that they have less capital to divvy out to both workers and consumers, but also investors via dividends or share buybacks. But given the context of this video, let's say Trump gets elected for a second term. The CBO estimates that the federal deficit will widen by $4 to $5 trillion over the coming decade. Again, not all sunshine and rainbows for the Trump supporters or Trump lovers out there. But, you know, the CBO can always be wrong, just like everybody can be wrong. As I've already mentioned, Trump's goal is to outgrow any increase in the deficit via increased GDP growth and increased tax revenue because of increased economic growth or activity, rather than just increasing tax rates on consumers and businesses at current day economic policy and economic growth, if that makes any sense. Another way to put that is if you just think about the current corporate tax rate of 21%, and if a company does $100,000 in net income, currently they're paying $21,000 of income tax to the government. Well, if economic growth expands and let's say that same company then does $200,000 of net income, if that tax rate stays the same at 21%, the government is still taking in more cash because that company would instead pay $42,000 to the government as a result of increased revenues and profits of the company. So those are kind of the two different angles and approaches economists and presidents and economic advisors take. Either you raise tax rates on the current economy, or you hope that as a result of keeping tax rates low or even taking them lower, you'll have increased economic growth, which will outgrow any increase in the deficit you might see as a result of not increasing those tax rates. I know it can get a little bit confusing, but I hope I'm making some sense. But let's say the Congressional Budget Office is correct and the federal deficit does widen by $4 to $5 trillion over the coming decade. It would simply mean that the Treasury Department would have to borrow more, unleashing a torrent of supply that would likely outstrip demand at current rates. That's what I already talked about. And as a result of that, yields and rates would probably have to go up in order to supplement that increased supply but lack of demand for Treasury yields and just any debt-bearing instrument in the economy. But anyways, with all of this being said, how can we best position our portfolios? Well, the first and foremost thing I want to mention is whatever you do, stay in the markets if you can afford to do so. I'm talking to more the younger audience here. Obviously, if you're approaching retirement age, you probably shouldn't be in the stock market anyways. You should be in this bond market getting 4 to 5% risk-free on your money. Even I'm getting 4 to 5% risk-free on some of my money at 23 years old. I think it's just smart to do so. But yeah, if you're young or you're still trying to grow your retirement portfolio or you're just starting at investing, stay invested into the markets. Worst case scenario, the stock market goes down and you can buy more shares of the companies you love for an even cheaper valuation. That's like your favorite candy bar at Walmart being 50% off, right? You want to buy more. It's more enticing to buy, and that's the way it should work in the stock market as well. Now, to really know how to best position our portfolio, we do have to look at his previous presidency, which is kind of difficult to look at because there were a lot of very rare events that happened, including the Great Virus Crisis. So take this all with a grain of salt. But, it is true that under his presidency, there were no major uprisings and geopolitical tensions or conflicts overseas. And as a result of that, and as a result of domestic oil production, the price of oil went down. Right now, if you look at the price of oil, there is a geopolitical risk premium being priced into a barrel of oil right now. If you believe Trump in saying that he can get the world's problems solved the day he takes office, you will want to short oil. Oil prices will go down. That's just a matter of fact. And this is just simply because that geopolitical risk premium that is placed on oil prices right now, that would go away if geopolitical risks went away. Secondly, you would want to overweight domestic companies and underweight international companies. This has been the case. I've been saying this for 8 years now. You want to be invested in the United States of America. Overseas is going to be a challenge just with the current political climate. You have China going through a recession. Lots of other countries out there going through difficult times that are trying to export their way out of recession. You also have the likelihood that Trump loves his tariffs. He loves tariffs, and I don't think that's a secret. And if he comes out and reignites some trade war, you're not going to want to be invested in these international companies, especially the Chinese companies. So yeah, that's another thing. Overweight domestic companies, underweight international companies. The fact of the matter is there are plenty of great investment opportunities in the United States of America. You don't have to leave our border to find a great investment opportunity. That's just my opinion. I could be wrong, but that's what I believe. Third, you may want to consider shorting the dollar. This is because Trump has suggested that he may try to devalue the dollar to boost our own exports, which would be stimulative to the economy. Everything Trump wants to do is stimulative to the economy. It might be at the expense of something else, but he's doing his best to stimulate the economy. Right or wrong, if he devalues the dollar, he's going to boost our exports. Again, this is probably why investors also believe inflation will be sticky or will have increased inflation relative to a Biden presidency. If you devalue the dollar and you have increased exports, you're going to have more inflation than you previously expected. It's just a fact of the matter. And you're also probably going to see a little bit of pressure put on the US dollar as the world reserve currency. The whole purpose of the US dollar being the world reserve currency is that it is a strong base. It's a strong denomination, and it's the strongest in the world. So if the dollar weakens, there is a risk there that the US dollar will no longer be the world reserve currency, sooner than later. But you also have to realize that it's not any of these other countries' incentive to be the world reserve currency. It's actually more beneficial to their economy if their currency is weak because they can export more and their exports are more powerful to their economy. That's what Trump's trying to do here. He's trying to boost exports, which would come alongside the weakening of the US dollar. It is an economic strategy. Whether you agree with it or not, it's a whole other story. Now, one point I want to make, and this is the most political I will get, is there's a wide audience out there that says if Trump was our president, we wouldn't have inflation. That is just incorrect, and it's completely false. Maybe it wasn't Trump's fault, but we printed trillions of dollars as a result of the Great Virus Crisis. It is simply impossible by any monetary standard or economic policy not to have some inflation if you print trillions of dollars over the course of, 12 months, 8 months, whatever it was. We would have had inflation. I agree with the argument that if Trump was our president today, we wouldn't have as bad of inflation. I don't think Biden has done anything to help tame down inflation. I think he's probably made it worse, but to say that there wouldn't be inflation at all if Trump was our president currently, simply false. Now, if you've been following my channel for a while, you'll know that I have this thesis that the stock market and basically all assets out there, the housing market, land, Bitcoin, gold, whatever it is, any asset out there is going to form another bubble. I think that's how this stock market and this economy is going to crash next. It's the only way I see feasible because the government has proven if any other scary scenario pops up that threatens the economy, they're just going to throw money at it. They're going to print money, and it's likely going to solve the problem short term. But the risk then comes if the government misidentifies a crisis and they throw money at the system when we don't need it, which is kind of what the government's threatening to do if they cut interest rates right now. We're going to see an asset bubble form. I mean, we have a lot of speculation out there right now, but the bottom line is a speculative bubble may not be fully formed for another 12, 24, 36, 48 months. Just go back and look at what the tech bubble, how that played out and how long that bubble took to form. This could unravel over the course of years. I believe this is the most likely scenario. Eventually something breaks. Eventually, consumers and businesses take on too much risk and we don't see that risk and we take on some bad debt deals again, like the great financial crisis, and eventually something breaks. And that's when this bubble will pop. That's the most likely scenario to me. And if Trump is elected president, I think it's just going to speed up how quickly this bubble does form. We're going to make a lot of money short term as investors if Trump is elected. This is I'm opinionating now. I'm not spitting out facts. This is my opinion. If Trump's elected, we're going to make a lot of money short term as investors because I think asset prices will absolutely skyrocket. The fallout afterwards, though, it likely will be put on whatever the next electorate is, whether it's Republican or Democrat. Mark my words, they're probably going to see the fallout of this speculative bubble popping. Again, this could be 2, 3, 4, 5 years down the road. I think it's going to be the next presidency after, potentially Trump's second term here. But yeah, you look at how much money printing the government's doing. You look at how Trump wants to stimulate the economy basically at all costs. I don't think he thinks there's a ceiling on the appropriate amount of economic growth when in reality there is, otherwise you form a bubble. But yeah, get ready to make a lot of money short term. The top is going to be very hard to time. But again, as I started the video with, and I mentioned a couple of times throughout this video, the best strategy through everything is to hold on to what you own. If you own high quality companies at cheap valuations, hold on to it. Hold on to it. Own companies that if the stock market was closed for the next 5 years, you would be happy to own them. If you could not see the stock price every day, you would be happy to own that company and own a percentage of their revenues and their profits. Own that company. We've had the Great Depression, the tech bubble, the Great Financial Crisis. Things happened in the 80s and 90s. Even before that, we've had countless recessions, a couple depressions really. And the stock market, sorry, my camera's shaking. And the stock market has been fine through all of it. Again, I'll throw up this chart on the screen. Ever since the stock market started, all it's done is gone up in a straight line. And that's what it's going to continue to do, even if we see some sort of crash under a Trump presidency or under a Biden presidency. That's all it's going to do. We already saw a horrible bear market under President Biden in 2022. But guess what? The stock market has already recovered from that bear market, and we're well above the previous highs prior to that bear market. The stock market has been okay. But with that, I'm going to end this video here. I hope you guys have a great 4th of July. Again, if you're new here or returning not yet subscribed, please subscribe down below. If you want access to additional macro data like this and breakdowns like this while supporting me monthly, you can consider joining my membership by hitting the join button located right next to the subscribe button or hitting my Patreon link in the pinned comment. I'm entirely self-funded. I'm independent. So your monthly support does mean a lot to me. But with that, I hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.